Welcome everyone to Macro Matters. This is our bi-weekly conversation about the macro events that matters for our members in the finance industry. My name is Lotta Moberg. I am the co-CIO and founder of Vivify, which is a private credit and equity firm which invests in the cannabis space. And I have with me Tony Zhang and Rich Excell, which are both of the Geese College of Business. Welcome, guys.
Hi, Lotta. Hi, Tony. How you doing?
Hi, Lotta, Rich. I think this week is very exciting week, and especially I think a lot of investors would love to know what happened over the past 1 or 2 weeks.
And it's really exciting for Lotta because she has a new job on this Macro Matters podcast.
I do have a new job. Now, maybe we should talk
Congratulations.
about my new job, but I know that you're so eager to talk about stablecoins today, so I'll leave you another 2 weeks, and maybe we can hit that next time. So I have been a macro investor though before my current job for 7 years, and I did a lot on currencies. And one country that I actually tried to invest in, as so many other people out there lost money, is Argentina. Now, reading about the Argentinian history, they did have something that is called the currency board, and that collapsed actually in December 2001. Currency boards are, I think, the greatest invention ever in monetary policy. If you do need a monetary policy, a currency board is great. The problem is that central banks often don't have the incentive to run them well. Often what happens is they're supposed to be collateralized 100% with the currency towards which they fix their currency, often the US dollar. Now, the Argentinian government didn't do that, or the central bank didn't do that. And that has generally been the reason why now, if you're proposing currency board in most places, they still do exist in some places. Cayman Island has a well-running one. Most places will say, no way, look at Argentina, they always fail. Now, the parallel that is going on right now in front of our eyes has to do with stable coins and the cryptocurrency space. And I have two wonderful gentlemen, of course, to talk about this and fill me in on a lot of things that I don't understand about this. And so I hope this is going to be a good conversation. We're sitting here on May the 18th, and this is a turbulent time for, especially, I would say, a lot of people actually have heard for the first time about Terra and Luna. Luna being the sister currency, so to speak, of Terra. So they're very much intertwined. And there's a system that was set up in which Terra was supposed to be one-on-one with the US dollar, and Luna was supposed to follow along with Terra. They're generally set up as an arbitrage opportunity scheme where they're not supposed to be able to diverge, because somebody can always come in and arbitrage between them. If you're saying that gold and silver, for example, have the same currency exchange value, and you have a figure that comes out and says, I promise you to exchange 1-to-1 for gold and silver, or whatever ratio you want, you would think that that ratio is going to hold. Otherwise, there'll be opportunities to exploit that. Now, something crashed in this market. It crashed in such a substantial way that we also saw a lot of cryptocurrencies got nothing to do with either stable coins or any complicated really schemes about holding them steady to do, including Bitcoin. So why don't we start with, I can hand it over to Rich first to just give us a rundown. Like, many people will hear me saying Terra and Luna, and they will think, I did hear about that, but how could they possibly work? Are they two different stable? A lot of people will think they're two different stable coins, both denominated by US dollar or something like that. Maybe you could just at least start with give us a rundown of how their scheme worked. And then we can kind of broaden maybe the conversation, because we don't want to only talk about those currencies, of course.
Sure, absolutely. I mean, it's not too often that you have a lunar eclipse and a lunar collapse all in the same week, but this week was definitely special that way. So, I mean, you mentioned Terra and Luna. I think, we could also add on UST, and as well as Anchor protocols and all these other names that get thrown around, and all part of the same idea. So when we think about it, we have the Terra blockchain. So we understand, like in the crypto, everyone's built on a blockchain, right? And that's essentially the foundation from which all these other ideas are kind of built. And, Bitcoin has its blockchain, and we have Ethereum that has a blockchain, et cetera. So everyone has their different, their different foundation from which things are built. And so when we look at it, you had a stable coin built on this blockchain called UST. And then you had Luna, which was a token that was related to the success of the blockchain overall, but it's particularly where we're seeing the growth in the stablecoin. So as the money was flowing in to the blockchain and to the protocols built on the blockchain, the value of Luna is going up because the value of Luna was tied to how much people were using the blockchain, how much they're building different protocols on top of that blockchain. And while this blockchain was built, and the stablecoins are an essential part of DeFi type of blockchains to really have a place for people to move in and out of the blockchain. And so it gives people confidence to build other applications on top of that. It ultimately got to be where one of the biggest and most dominant applications built on top of the blockchain was the Anchor, what they call the Anchor protocol. And the Anchor protocol, what it offered to investors was, that with their stablecoin, they would just have to deposit their stablecoin into this protocol. And it was offering yields in excess of 15, 18, sometimes 20% annual yields, which seems really too good to be true. And a lot of money was therefore flowing into it. Of course, in a yield-starved world, people are going to chase the highest yields wherever they can get them. And this isn't the only stablecoin or only protocol that's offering higher yields. Typically they're in the 5, 6, 7% range. And so this was definitely, a higher yield that was being offered. But ultimately, we saw a great deal of money flow in to chase these yields and try to lock in these yields. And if that drove up the value of Luna, because again, the more money's flowing in, the more people using the blockchain, the higher the value of Luna goes. And like you said, the Luna and the UST stablecoin, there was an arbitrage there because it's an algorithmic stablecoin. It's not a fully collateralized stablecoin. And in some ways, it was collateralized by the value of Luna. Now, interestingly, somewhere along the way, the foundation that runs the blockchain decided to buy several $1 billion worth of Bitcoin, which was kind of interesting. And in some ways, it would add some strength and stability because there's more collateral being put behind the blockchain. But interestingly, it also kind of pointed out to the weakness that the fact that Luna was stabilizing was the collateral behind Terra's blockchain, which supported Luna, kind of showed that it created this unsustainable potential vicious circle. And so it was really kind of an admission of weakness, even though it was adding some strength into that. And it seemed ultimately, well, depending on the account that you read, it was either a coordinated hedge fund attack akin to George Soros breaking the British pound peg, or it was really just simply a run on the bank as money started to come out and everyone else who was in there started to come out. I'm not here to say which one was which, but ultimately, as you point out, that with this algorithmic stablecoin, as money started to flow out, the way it would set up, then therefore, as the value of UST went down, then Luna would go down to kind of support the UST because there's an arbitrage, but then that was just driving the vicious circle out. So it was more of akin to a run on the bank. At least that's kind of how I see it. But I guess for me, a bigger question then is, it wasn't a small event, right? It was anywhere from 40 to 60 billion dollars, depending on who you ask, which some would say was the value. I mean, point out that was the value of Lehman when it went bust in August or September 2008. But of course, Lehman had far more assets, $600+ billion of assets, and had a much more global footprint. So the question is it really systemic? And if it's systemic, is it systemic for the DeFi community, for the broader crypto community, or for all asset classes? And so I guess for that, I would want to ask Tony what his thoughts are on that.
Yeah, Rich, I think you have given a very good rundown for what had happened over the Terra's UST and Terra's Luna. I think to really understand the overall what have happened, I think the one basic concepts is the stablecoin, because this is a stablecoin. People have been talking about this for quite a while. It's actually the centerpiece of overall the DeFi. We have run a great event over the DeFi over the past, and I think a lot of financial professionals have known at least what the DeFi is. But the key definition, the key component for the DeFi is the stablecoin. Stablecoin is the cryptocurrency that packed to a more stable currency, typically US dollar. What that means is typically, for instance, like a 1 UST, claimed to be a stable coin was supposed to be able to convert it into $1 at any given time. That's what people call it a stable. Now, what that means is whenever a UST was being traded or being priced slightly below $1, they have some arbitrage or traders can come in and buy the UST and actually and it converted into $1 of the other coin like Luna and sell the Luna simultaneously. And actually, in that scenario, is that they're going to make 1 cent of profit. If there's like, for instance, like if UST went down to 99 cents, that for each trade, the trader will make 1 cent. This actually provide a very nice arbitrage opportunity for lots of institutional traders. For instance, like one big institution in this turbulence is apparently junk trading. A lot of people actually have concern about whether junk trading has actually either made money or have lost significantly, which is actually just rumor. We don't know, but we don't try to speculate over that. The key thing is what happened is once the stable coin become unstable and supposedly theoretically supposed to be stable become unstable, that is going to cause some catastrophe. And Richie actually just mentioned about the reserve, which is actually used to be a great, or people call it a very smart way to protect the value of the stable coin. For instance, the reason that the Terra actually they create the reserve of using the reserve to buy the Bitcoin is whenever UST is being traded below $1, that they're going to sell the Bitcoin and use the proceeds of the sales to buy the UST. And at this moment, what we can see is as long as the reserve actually is there, they can actually maintain that the UST supposed to be valued around $1. And every time, whenever the UST is being traded above $1, the foundation can actually sell the UST. They can continue to sell the UST, and then by selling, they also make some profit, and using the profit to buy the Bitcoin and use it as a reserve. So as long as this is kind of mechanism supposed to be very smart, continue to hold on to it, that we shouldn't see any collapse. Well, it is important. It was actually important in the past because, as you already mentioned, is the stablecoin provide a way for cryptocurrency loaning and borrowing, right? It's a fundamental technology of DeFi, and without the stablecoins, that people is not going to invest into the DeFi. And apparently, over the past, one of the big marketing piece for the DeFi is that whenever you actually put the money into a stable coin, which they call it staking, as we pointed out, and they could generate a yield about 15 to 20%. Well, versus in the past, when the interest rate was close to zero, you make nothing by putting your money into a bank, right? You literally make nothing. Well, simultaneously, well, I can stake my capital into a stable coin and making 20% on an annual rate. Wow, fantastic. So a lot of investors pouring their capital in, and supposed to be stable, people will feel it's extremely safe, stable, right? And especially with a couple $1 billion of reserves over there, this should be provide one sense of security for lots of institutional and retail investors. However, there's apparently one drawdown or one shortcoming over here is because of the stablecoin created by the Terra UST is not backed up with the real US dollar as what you say collateral. This is non-collateral as versus the other stablecoin USDC, which is backed up by the real US dollar. Now, without the real US dollar, so if this algo correlation between UST and Luna actually does not hold, this is exactly what happened like in May 7. What happened was in one day, okay, suddenly one day is one big maybe big guy, we don't know, it's an institution or or a person, suddenly actually stake $2 billion of USD and simultaneously dump it into the market. Now, at the moment is supposedly what's going to happen is the foundation has to sell the Bitcoin and use the proceed from the sale of Bitcoin again to buy the UST. But at one moment is you can think suddenly $2 billion of dumping coming out. How fast can you actually sell the BTC to host the value of the UST? And what happened is it didn't hold. When it didn't hold, the investors supposed in that UST stablecoin become panicking, and they keep selling the UST, unloading the UST. And whenever they unloading the UST on the reserve, the foundation has to continue to sell the BTC to use the reserve to hold the value. What if this is a process continue to dry down and all of the reserve was used out as quick as possible at this moment? That I think that the relationship just didn't hold, and the whole thing just collapsed.
That's a great, and I think that, by the way, Tony used an analogy, a acronym here, BTC, that is Bitcoin, so you're basically saying it seems that it was maybe a liquidity event in the beginning, but it turns into an insolvency event. And I bet it wouldn't have helped that the Bitcoin price is going down at this time too.
Correct. Remember what happened, what we call a fresh crash in financial crisis back to year 2008. It actually also it was the liquidity issue simultaneously, when the liquidity in the equity market, stock market actually dried up because of the high frequency trading. And suddenly they went out when the liquidity was most needed by the market, that every stock, every asset fall. And it actually happened at this point here is when the liquidity was mostly needed for holding the value of UST, then everything just fell off. And we see a sell off in the crypto market as well. And now the value of Lunar was completely wiped off. And as Rich is saying, almost 40 to 50 billions of total value of the crypto market has been wiped out over the past 1 or 2 weeks. This has been one of the biggest events, or almost like a Lehman moment, right? As Rich is saying, like Lehman moment in a crypto market. The bigger question is here, what's going to happen? What will be the future for the DeFi, and what might be the future for the crypto market? Will actually this catastrophic event cause the attention of regulatory agency, including the Treasury Department and also SEC, right? So that's the big question mark right over there.
So I think it might be useful, Tony, for you to just repeat that number. How much value has been destroyed from this event?
Well, by the Terra by itself, Terra and Lunar by itself is roughly about 15 billion. But the overall market from the crypto market has roughly about 40 to 50 billion dollars.
40 to 50 billion.
Yes.
Okay. And people speculate out there about, and I actually forgotten, it's something trillion, about the total size of the market today.
Well, the crypto market totally at the peak not too long ago was almost $3 trillion. And today it's around $1.2 trillion. And so it's about, it's come down about 40% from the peak.
Correct.
But if we consider that, I mean, that is the size, it's comparable to the size of the kind of rescue packages that we had from the US government, for example, that flooded the world really, as the Americans spent so much of that money with a lot of extra money printing, right? It was not just in the US, even though the US, you see that first, and then it spreads throughout the world. And here we have the reverse of that, and we usually don't see a contraction in the opposite direction that is also so very quick and so very unexpected in terms of just people's wealth. Of course, the size of that number, whatever it is. If we think about it, I think it was a 2.5 billion package or something like that from the government once, but more and more money, of course, kept coming out. If we think about the size of that, of course, that's corrected by inflation, is a smaller, it would be a comparably smaller number today. And that is a reminder too, that as we talk about stable coins, we're also referring to a current currency of the US dollar that is not inherently stable in itself. But that's, I wonder if you guys have any thoughts about just the macro implications of this. Like if you're wiping out a lot of wealth suddenly, I mean, we see this, and we could touch on too what the connection is here to the stock market. We've seen the stock market coming down now. I do not profess to know what the causation is here from a correlation of crypto and stocks going down at the same time. It can very well be that because crypto goes down, you have a portfolio reallocation effect, people selling off stocks. It could be a risk aversion effect, or it could be some inherent causation between those. You would think from the belief of say, a Bitcoin hodlers and the like, that the correlation would be negative, right? Like if you have currencies, if you have the stock market going down because of higher inflation is exactly when you'd see in dollar terms, not in real terms, but still in dollar terms, the crypto currencies going up. Or I'd say not necessarily in real terms. So any of you, do you want to start, Rich? Just kind of that
so I think
broader.
you bring up a lot of great points. I think, of course, there's the reflexivity argument, right, or the wealth effect argument, that as wealth goes lower, there should be a negative impact on the economy going forward. I think there's certainly an expectation of that. The same way when wealth was being created, whether that was real or not real, the economy was doing better. Again, I'm with you. It's hard to say where the causation is, where there's clearly correlation. I think interesting to me to step back and look at, if you look at the internals of each market, there's a lot of similarities, right? So we talked about how DeFi is struggling a little bit more than the Bitcoin protocols. So in some ways, even within the crypto market, there's a flight to safety. If we look within the equity market, you see S&P doing a little bit better, frankly, a lot better than like the NASDAQ or the Russell. So there's, even within the equity market, there's a bit of a flight to safety. We've seen that flight to safety in the bond market, people moving to the shorter dated bonds. We've seen it within the credit market, where people are, want to get the investment grade type of credits. You see it within the currency markets, where there's a flight to the dollar from some of these other currencies. And so there is, even within each market, there's an element of a flight to safety. So then the question is, what's the safest asset across all of the markets? And that's where I think when you get to the portfolio reallocation, I think it would be somewhat naive to think that there isn't some element of that, because one of the big bull stories for the crypto market the last 18 months was the fact that institutions were finally getting involved in some ways in a big way into the crypto space, which was a big positive driver. And so what we can expect with the way institutions manage money, whether that's asset managers or asset owners, is they're going to be looking at some expectation of returns, some expectations of volatility or risk, and some correlations across assets in their portfolio, and trying to build what they think is somewhat of an optimized portfolio. And so I think the fact that the crypto space has gotten more correlated in some ways leads to the fact that people will want to have, because the volatility numbers are higher, won't see it as diversifying as it was before. Of course, crypto was almost the perfect asset to add before, because it had high returns, yes, high volatility, but almost negative correlation. So everyone wanted to add it. But now that it's, the returns are maybe not so great, and the volatility is still high, and the correlation's positive, maybe not so great. So again, it's hard to say, but I think as institutions have moved into different asset classes, we certainly always see the same sorts of behavior, that there tends to be in times of crisis, which we can say we're in right now, as central banks globally are removing liquidity, correlations across asset classes move towards one when there's very difficult conditions in the market. And in some ways, that's really what we're seeing here. And that's some way, to me, an institutional effect. But I don't pretend to know. Maybe I will hear what Tony has to think.
Yeah, I think both of you, Rich and Lotta, had made a lot of points that I think it's a very valid and very valuable, especially because for crypto investors, apparently this is a defining moment due to its size and impacts, right? In terms of the amount of people that have lost substantial amounts. Well, even for the non-crypto investors, now it's actually what we have seen is the equity investor, another perspective, also has lost tremendous amount of value at the same time when the crypto market actually stumbled. Now, in the past, when people think about the crypto investment is using as an altcoin or alternative asset investment vehicle, is they thought both of assets has low correlation. There was supposed to be low correlation between the crypto market and equity market. And having both of the assets into their portfolio would create some kind of a diversification effect to lower the overall risk. However, at the moment that we saw, or we at least have monitored, we have seen that both assets actually move in the same direction. It's instead of reducing the risk for overall portfolio, but actually increased the overall risk. This is a historical moment for both crypto investors and non-crypto investors at the moment to think whether actually two assets should be added. Now, the reason apparently behind that is still unknown. But however, as both of you have hit the point that it could be that investors has, especially institutional investors, has already incorporated both asset classes onto their books. So whenever there might be some risk at one market, we see the huge risk at one market. To actually maintain the overall risk of the overall portfolio, that the institution has to actually de-risk on other asset classes, including both bond and equity, which actually would give a lot of unprecedented pressures over other asset classes, including the equity market. I think that's one of the very reasonable explanations of why we actually see the high correlation between two supposedly uncorrelated asset classes. Apparently, one big question for the future is, are we going to see more of regulatory actions into the institution to basically to regulate it, for instance, whether they should actually report the holding or the position within their book, even though maybe superficially the equity crypto holding are actually not reported, but should they be reported? And this is actually a bigger question to actually ask.
Institutions and the like would need to report already, right, if they're holding crypto?
Well, they would have to report it, not necessarily public. Depends on whether it's on they actually issue the same of the product to the public or just to some use it as a hedge fund type of product. If it's the hedge fund type of product, then probably they might already be required to report it to SEC, but not necessarily to the public.
Okay. I think it might be also really good for us to touch on this this difference between the stable coins and the non-stable coins. If we're talking about things moving around a lot, we're talking about usually non-stable coins. I would guess that and these people will know it's like the Bitcoin, Ethereum will be the two biggest ones. Solana is a big one now as well. I would guess that when we're talking about institutions getting into this space, most of them are not getting stable coins to stake. They are instead buying the coins that could go up a lot. We have more volatility. They want more volatility because there's a bigger upside to that. So those coins are the ones that they will be selling out. So that wouldn't hit the stable coins. On the other hand, you have the stable coins. In many ways, they're not very intertwined. I mean, it's not like Bitcoin is inherently pinned to a stable coin and the like. So it seems like if there's a faith that is being lost out there, about stable coins, why would that hit the non-stable coins? I wonder if it's more like a mental thing going on. It's just a general like, well, there's risk off out there, and that's what's going on.
Lotta, when you actually talk about non-stable coin, apparently people instantaneously think about BTC, Bitcoin, and Ethereum, but they also simultaneously think about other crypto as well. Now, what we know is one of the most famous or infamous characteristic of crypto is the high volatility, right? It depends on whether some people, do you love the volatility? Well, for institutional investors, they are supposedly they should be very risk averse, and they tend not to like the crypto, the traditional non-stable coin of BTC or other cryptos. To really get the institutions' interest into this crypto market, the stable coin with low volatilities is the key. That's why now when the overall revolution, financial revolution comes in, and lots of players introduce the stable coins, especially with the key feature that we have some both of reserve to protect the value of the stable coin. Now, the low volatility of the return for this for those stable coins actually become a key feature to attract institutional investors, right? If I am an institutional investor and you are telling me that my value is very stable, I give you $100 million. Now the $100 million will be backed up by $1 billion of reserve. So I have a security over there, and simultaneously I can stake my stable coins and making 15% return for my clients or for my investor. I'm extremely happy on the low interest rate environment. Simultaneously, when the security equity market is at a very high point, apparently this is a great selling point. It is good selling point until it fails. This is a story always has both high and fade and tides, right? So I think this is a story just repeated by itself. Rich, what do you think?
Well, I think the interesting thing is, where do people think the 15% yield was coming from? If it's ultimately linked to, I mean, not all stable coins are linked to the dollar. I think the ones we're talking about, and the most popular ones are because we're largely in a dollar-based global economy, but there's stable coins that are linked to euros and pounds and gold, et cetera. And so there's other stable coins. These were the most popular ones. But if on a US dollar account anywhere in the world, you're going to get less than 50, not less than 1.15 basis points or 15 basis points, why do you think you can get 15% on these? What's going on behind it? And of course, what you find out is that maybe there was some lending out of those coins. Maybe there was some marketing that was money that was going in to pay those. Again, the Terra Foundation would have an interest in spending some marketing dollars and paying high yields, because the more money that kind of came into their blockchain and would inspire people to write apps on top of that blockchain, which drove up the value of Luna. And so there was an argument for them to spend some marketing dollars on there. And so you wonder where that was coming from. So it wasn't all real. And so I think as an investors, if something's too good to be true, it usually is. And so you want to always ask yourself the question of, where's this 15% coming from, and really dig into that. And I think maybe to me, that's one of the more interesting takeaways from this. But I think to me, also the 2008 analogy, if there is one, isn't really Lehman Brothers per se. It's more when the money markets broke the buck, if you will, because we always expected the money that would sit in a money market account that we could then use to move into riskier assets if we wanted to take risk, or move them back into the riskless assets, always supposed to hold that $1 price tag. That's where stablecoins are much more similar in my mind. That yes, maybe you could get some yield on other stablecoins don't offer that same amount of yield, but they allow you to be in a stable, riskless, presumably asset, and then you can move into other coins to take risk when you wanted to, and then move back out, all trying to stay within the crypto ecosystem. So to me, the question is, if we've broken the buck in the money market, and we saw what happened in 2008 to a lot of asset classes that were dependent on the money that came from money markets and short-term interest rate markets, et cetera, that really kind of broke the plumbing of those markets. The question here would be then, does this break the plumbing of the DeFi market? Because these stable coins are really that money that's kind of coming in supporting those other coins.
Right, you can have a market for the non-stable coins, but you don't get the whole ecosystem of DeFi that we were hoping to see a lot of. I think I'm going to start wrapping it up here, and I'll give you the last words, guys. But I really want to thank everybody for listening, and hope that you've gotten a little bit more sense of not only there's a lot of things out there very focused on what the coins are doing, but we want to try to put in the macro perspective and the market perspective to see kind of how everything fits together and why things move together or when they don't move together. So each one of you, just final thoughts. Maybe I'll start with Tony, because I do know that you have thoughts about the future of DeFi. Maybe that's a thought you want to give us, and maybe you can both give us also the sense of, this is never investment advice, but is this the time to just buy something that is very cheap? Start, Tony.
Lotta, definitely. I should not say that this might be the moment to be that people should not consider about adding the crypto asset into their overall portfolio. But definitely, this is a very, very important moment to think about the risk associated with investment into the crypto market, especially about the non-stable coins. Now, the collapse between the Terra, the UST, and the Luna gave investor a great lesson to start it. Like, what should be the mechanisms behind that, and if they invest in the future can actually learn from the lessons of the collapse and come up with a better mechanism to protect or actually calculate the risk with their overall investment portfolio. I think it's still quite worthy to actually think about this. Because the crypto market, especially the market established by the Bitcoin and Ether, had become such tremendous. It's a market that we should not be ignored by investors, especially institutional investors. But overall, we still need to keep in mind that the risk is still quite huge, regardless whether it's called a stable coin or non-stable coin. And I believe that in the future, when the regulatory agency step in, we could potentially see maybe a more stable market for crypto assets. I have to keep an close eye on it. I hoping that regulatory agency can step in and make the overall market more stable than ever.
I'll just jump in as well, because I mean, the question I asked for is like, is this a systemic type of event, et cetera? When you have massive losses like we've had, it's always going to leave a mark. The question is like how long and how lasting that mark will be. I think many people are asking, well, will the Fed finally back off the rate hikes, et cetera? I mean, ultimately, as we talked about in our macro matters about duration, the bubble, if anything, maybe was in all assets that had long duration, and maybe that's some of what we're seeing. And will the Fed back off? Well, the Fed's not going to back off until we see inflation coming lower. So then the question is, will these losses that we're seeing in financial markets start to have a negative impact on the economy because of wealth effects, which will naturally bring down inflation, which will take the Fed out of the equation, which maybe at some point provide some support for asset markets. I think that's what investors should be looking for. I know that's what I'm looking for. Price is what you pay, value is what you get. And just because prices are lower, I'm not so sure we have value yet, but it will be interesting. It'll be interesting to see if the economy can somewhat decouple from what's going on in the financial markets, or if the financial markets will have a hangover effect on the overall economy. I don't think we've seen that yet, but I think that seems to be what the market is most worried about, and it's starting to price in a little bit. And so that will be the interesting thing to watch, I think, over the next month or so as we go into the summer.
I actually really loved the comment that Richard just made. Actually, especially in this environment, when we see the depressed situation in both financial market, including both crypto, bond market, and also the equity market, it was actually mainly caused by apparently the action taken by the central bank. And as Rich pointed out, the central bank probably is not going to soften their stand until we really see the inflation actually start to decrease convincingly. This is using their words, and especially in this environment, as what we have mentioned right at the beginning of this year for investors and for people who have been watching our macro matter, is that this year is going to be very, very tough, and it's going to be very, very challenging. Risk management is the key for the rest of the whole year.
So invest accordingly, and everything is connected would be the summary.
Exactly.
Thank you so much, guys, for joining me today.
Thanks, Lotta. Thanks, Tony.
Thank you,
Good to see
Lotta.
you guys.
Yeah, thank you, Lotta. Thank you, Rich.